What if I told you that living off dividends with $2,900 a month is possible, but probably not the way most people imagine it? Online, it sounds simple. Invest some money, collect dividends, and suddenly you're free. No boss, no alarm clock, just passive income rolling in every month. But here's the problem. That story skips the math, and when you skip the math, you end up chasing an illusion instead of a plan. In this video, we're going to do the opposite of what most dividend videos do. No hype, no shortcuts, just real numbers, real expectations, and a clear picture of what it actually takes to generate $2,900 per month in dividend income, consistently, safely, in long term. I'm not here to sell you a dream. I'm here to help you understand the system, because once you understand the system, you can use it to your advantage instead of being disappointed by it. Over the years, after breaking down countless portfolios, dividend strategies, and income projections, one thing becomes very clear. People don't fail at dividends because they're lazy. They fail because they were taught the wrong expectations from the start. So before we talk about how much you need invested or which assets pay dividends, we need to start with something more important. Why most people believe living off dividends is easy and why that belief is so dangerous. And that's exactly where we're going next. That belief that dividends are an easy escape from work didn't come out of nowhere. Scroll through social media and you'll see it everywhere. Screenshots of dividend payments, titles promising monthly passive income, stories of people who retired early just by investing, and slowly, a dangerous idea takes root. If others did it, it must be simple. But here's the uncomfortable truth. Most of those stories leave out the hardest part. They don't show how long it took, they don't show how much capital was required, and they definitely don't show the years of discipline before the dividends ever felt meaningful. What happens instead is this. People assume dividends work like a salary replacement. They believe a modest portfolio can somehow produce a full lifestyle, so they invest with unrealistic expectations, and when reality doesn't match the fantasy, they quit. This is where most dividend strategies fail, not because dividends don't work, but because people misunderstand what dividends are designed to do. Dividends were never meant to be a magic switch that turns work off overnight. They were a slow, compounding system built on capital, time, and patience. And when you ignore any one of those, the system breaks. And this misunderstanding leads directly to the next critical question, one that almost no one asks honestly. If dividends aren't about instant freedom, then what does a realistic dividend lifestyle actually look like? To answer that, we first need to understand what $2,900 a month really means in the real world. Before we talk about portfolios, yields, or strategies, we need to ground this conversation in reality. Because $2,900 a month sounds very different depending on how you imagine it. For some people, $2,900 feels like freedom. For others, it feels impossible to live on. And the truth is, in the United States, it's neither luxury nor poverty. It's a modest, controlled lifestyle. At $2,900 per month, you're not buying supercars or living in high-end downtown apartments, but you can cover the basics in many parts of the country: rent or housing in a lower-cost area, groceries, utilities, transportation, and healthcare if you're careful. It's a lifestyle built on intention, not excess. To put this into perspective, the median individual income in the U.S. is higher than $2,900 per month before taxes. That means millions of Americans already live on something close to this number, but they do it by trading time for money. Dividend income changes the equation. The lifestyle might look similar on paper, but psychologically, it's completely different. You're no longer depending entirely on a paycheck. Your time becomes more flexible, your stress level drops, your decisions become less reactive. That's why $2,900 matters, not because it's glamorous, but because it represents a baseline of financial control. And once you understand what this number really buys you, the next question becomes unavoidable. How much money do you actually need invested to generate it every month without running out? That's where the math finally comes in. Once you understand what $2,900 a month actually represents, the conversation naturally shifts from lifestyle to math, because dividends don't care about motivation, optimism, or intention. They only respond to numbers. Let's start with something simple. $2,900 per month is $34,800 per year. That's the annual income your portfolio must reliably generate without you selling assets, without hoping for perfect market conditions. Now the key variable enters the picture: dividend yield. If your portfolio produces an average yield of 3%, you would need roughly $1.16 million invested to generate $34,800 a year. At 4%, that number drops to about $870,000. At 5%, you're still looking at nearly $700,000. This is the moment where most people feel uncomfortable, not because the math is complicated, but because it's honest. There's no trick here, no secret formula. Dividend income is simply a function of how much capital you've built and how efficiently that capital pays you back. And notice something important. The difference between 3% and 5% isn't just a number, it's hundreds of thousands of dollars. That's why chasing yield without understanding risk can be so dangerous. Higher yield reduces the capital required, but it often increases instability. This math doesn't exist to discourage you, it exists to give you clarity. Once you see the real targets, you stop guessing, you stop fantasizing, you start planning. And that clarity sets up the next crucial lesson, because if higher yield means less capital, why not just chase the highest yield possible? That question leads directly into one of the most common and most expensive mistakes dividend investors make. After seeing the math, it's tempting to think the solution is obvious. If a higher yield means less capital, then why not just invest in assets paying 7, 8, or even 10% dividends? This is where many dividend investors get into trouble. A high dividend yield often isn't a gift, it's a warning signal. In many cases, that yield is high because the stock price has fallen, not because the business is exceptionally generous. And when a company's fundamentals weaken, dividends are usually the first thing to be cut. On paper, a 9% yield looks incredible. In reality, one dividend cut can erase years of income overnight. Suddenly, the monthly cash flow you were counting on disappears, and the portfolio you built for safety becomes a source of stress. This is why experienced investors focus less on the yield itself and more on dividend reliability. Consistency matters more than intensity. A stable 3 or 4% that grows over time is far more powerful than an unstable 8% that may not survive the next downturn. The goal of dividend investing isn't to squeeze the maximum income out of your portfolio today. It's to build a system that keeps paying you year after year through good markets and bad ones. And that naturally raises the next question. If chasing extreme yield is risky, then where do reliable dividends actually come from? To answer that, we need to look at the types of assets designed to pay dividends consistently. If the goal isn't chasing extreme yield, then the focus shifts to something much more important: structure. Reliable dividend income doesn't usually come from a single asset. It comes from a well-built system made of different pieces working together. One of those pieces is dividend-paying stocks. These are typically established companies with long histories of profitability. They don't pay massive yields, but they tend to be predictable. Many of them increase their dividends slowly over time, which helps protect your income against inflation. Another major building block is dividend-focused ETFs. Instead of relying on a single company, ETFs spread your investment across dozens or even hundreds of dividend-paying businesses. This diversification reduces the impact of any one dividend cut and creates smoother, more reliable income. For many investors, ETFs form the backbone of a dividend strategy. Then there are REITs, or real estate investment trusts. REITs are legally required to distribute most of their income, which makes them natural income generators. They can provide higher yields than traditional stocks, but they also come with their own risks, especially sensitivity to interest rates and economic cycles. The key idea here isn't choosing the best asset, it's understanding the role each asset plays. Stocks bring stability and growth, ETFs bring diversification, REITs bring income power. When these elements are combined intelligently, dividends stop feeling fragile. They become more predictable, more resilient, and easier to plan around. And once you start building income this way, another issue quickly becomes obvious, one that quietly destroys many dividend plans without people realizing it. It's not about what you buy, it's about what you ignore. Once investors see dividend payments hitting their account each month, it's easy to become fixated on a single number: how much cash is coming in right now. And that focus, while understandable, is where many dividend strategies quietly fall apart. The mistake isn't wanting income. The mistake is ignoring everything else. When you focus only on monthly dividends, three critical forces get pushed into the background: growth, inflation, and taxes. Inflation slowly erodes your purchasing power. Taxes reduce what you actually get to keep. And without growth, your income may look stable on paper while becoming weaker in real life every single year. A portfolio that pays $2,900 a month today but never grows is slowly losing value, even if the payments feel comforting. Over time, that income buys less, covers fewer expenses, and provides less security. This is why experienced investors don't ask, "How much does this pay me now?" They ask, "Will this income still matter 10 years from today?" Dividend growth, reinvestment, and asset appreciation aren't optional extras. They are what keep a dividend strategy alive over decades instead of just a few years. And once you understand that dividends are a long-term system, not a short-term paycheck, you start thinking differently about another key question. If the system works and the strategy is sound, how long does it actually take to reach $2,900 a month? That answer depends less on luck and more on time and consistency. Once you stop thinking of dividends as instant income and start seeing them as a long-term system, the most honest question becomes unavoidable. How long does this actually take? The answer depends far less on talent or market timing and far more on consistency. Let's start with a modest but realistic scenario. If you invest $500 per month steadily year after year and your portfolio grows at a reasonable long-term rate, reaching a dividend income of $2,900 a month is possible, but it takes time. We're talking decades, not years. This path requires patience, but it also requires the least financial stress along the way. Now increase that contribution to $1,000 per month. The timeline shortens dramatically. You're still not rushing the process, but compounding starts to work in your favor much earlier. This is often the middle ground for disciplined earners who prioritize investing as a non-negotiable expense. At $2,000 per month, the math changes again. The timeline compresses even more, and dividend income begins to feel tangible much sooner. Not easy, but realistic for high savers who align their lifestyle with their financial goals. Here's the key insight most people miss. The market doesn't reward intensity, it rewards duration. Missing years at the beginning does far more damage than investing small amounts consistently. Time is the most powerful variable in this equation, and it's the one you can never replace. This is also where dividends quietly shift from being motivational to being strategic. As income grows, reinvesting dividends accelerates the process even further, creating a feedback loop between growth and cash flow. And eventually, something changes. You stop asking, "How fast can I get there?" and you start asking, "How much freedom does this already give me?" That shift leads directly to the next realization, because dividend income isn't about luxury, it's about something far more valuable. As dividend income grows, there's a quiet but powerful shift that happens. The goal stops being excess and starts becoming control. Dividends don't usually buy mansions, supercars, or extravagant lifestyles. What they buy is time. Time to say no to work you hate. time to reduce hours, time to make decisions without panic. And for many people, that kind of freedom is far more valuable than luxury. This is where dividend income is often misunderstood. People expect it to replace everything all at once, but in reality, dividends work best as partial independence first, covering groceries, paying rent, handling utilities, reducing how much your salary needs to do the heavy lifting. When dividends cover even a portion of your expenses, your relationship with work changes. You're no longer trapped, you're choosing, and that psychological shift alone can dramatically improve quality of life. This is why dividend income is often compared to a full-time salary misses the point. A salary disappears the moment you stop working. Dividend income, when built correctly, keeps flowing whether you're working or not. And once dividends begin to buy time instead of things, another reality comes into focus, one that's impossible to ignore over the long term. Because even steady income doesn't exist in a vacuum. It lives inside a world shaped by inflation and taxes. That's the next layer we need to confront. No discussion about living off dividends is complete without addressing two forces that quietly shape every financial plan: inflation and taxes. Inflation is subtle but relentless. What $2,900 buys you today will not buy you the same lifestyle 10 or 20 years from now. Rent rises, healthcare costs increase, everyday expenses slowly climb. If your dividend income stays flat, your financial freedom slowly shrinks, even though the numbers look unchanged. That's why investors who rely on dividends alone without growth eventually feel squeezed. The income doesn't disappear, but its power fades. Taxes add another layer of reality. Dividend income is not always tax-free, and depending on where and how you invest, a portion of that $2,900 may never reach your pocket. Planning for net income, not just gross payments, is essential. This is why long-term dividend strategies aren't built only around yield. They're built around after-tax income, dividend growth, and asset appreciation. The goal isn't just to receive money, but to preserve its usefulness over time. When these factors are ignored, dividend plans look strong in spreadsheets and weak in real life. When they're accounted for, dividends become far more durable. And this brings us to the most important realization of all, the one that separates people who use dividends wisely from those who rely on them blindly. It's the truth that almost no one talks about when they promise financial freedom. Here's the truth that rarely makes it into flashy headlines or viral clips. Dividends are not the destination, they're the foundation. Most wealthy investors don't build their entire financial identity around dividend income alone. They use dividends as a stabilizer, a base layer of predictable cash flow that reduces risk, smooths volatility, and buys flexibility. On top of that foundation, they build growth, businesses, and opportunities. When dividends are treated as the finish line, people feel disappointed. The income never feels like enough. The timeline feels too long. The sacrifices feel heavier. But when dividends are treated as a tool, everything changes. Dividends provide security, not shortcuts. They reduce dependence on a single paycheck. They give you options during market downturns. They allow you to stay invested when others panic. That's their real power. This is why many experienced investors continue working, creating, or building, even after dividends could technically cover their basics. Not because they have to, but because they want to. Dividends give them the freedom to choose, not the obligation to stop. Once you understand this, the pressure disappears, the strategy becomes sustainable, and the journey becomes far more realistic and far more rewarding. Which brings us to the final step, because understanding the truth is powerful, but acting on it is what actually changes your financial future. Let's close this the right way. By now, one thing should be clear. Living off dividends isn't about finding the perfect stock or reaching a magical number overnight. It's about building a system, slowly, intentionally, and with realistic expectations. You don't need to be rich tomorrow. You don't need to time the market perfectly, but you do need to start. Because every month you delay is a month your capital isn't compounding, and every year you wait makes the goal feel further away than it really is. Dividend income rewards patience more than brilliance.
It rewards consistency more than intensity, and most of all, it rewards people who are willing to play the long game when others are looking for shortcuts. If $2,900 a month feels far away, that's okay. It's not a starting point. It's a direction. The real win is reaching the moment when your investments begin to cover any part of your life. That's when momentum becomes real. So here's the question I want you to think about. How much of your future are you willing to fund today? If this video helped you see dividend income more clearly, take a second to support the channel. Like the video, subscribe, and comment below how much monthly income would make the biggest difference in your life right now. Because financial freedom doesn't start with a finish line. It starts with a single, disciplined step.